Oil jumped $11 in a single day, the biggest move since 1983. A U.S. fighter pilot spent 36 hours behind enemy lines in Iran before special forces pulled him out. The jobs report landed on Good Friday when every stock exchange on the planet was closed. And four astronauts are circling the moon right now for the first time in 54 years. This was the most consequential week of 2026 for your money. I am going to walk you through all of it: what happened, what it means for your portfolio, and the three things that matter most when markets reopen Monday. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here is what we are covering today: the market's best 4-day run of the year. The sector is split between tech and energy. A jobs report that tripled estimates. The Fed's vanishing rate cuts. Iran's war timeline in 4 acts. What the Strait of Hormuz means for gas prices. A moon mission. Our top and bottom portfolio holdings. And the bull and bear cases for the week ahead. The week of March 30 through April 2nd gave us the best 4-day stretch of 2026. Every major index snapped a 5-week losing streak. The S&P gained 3.4%. QQQ led at 4.0%. Small caps matched the S&P at 3.4%. The equal weight RSP came in at 2.5%. That gap between QQQ and RSP tells the story. Megacap tech and growth names led this recovery. Institutional buyers rotated back into their highest conviction positions after 5 straight weeks of selling. Small caps keeping pace is an encouraging sign. The Russell 2000 is more sensitive to domestic borrowing costs and economic conditions. Its participation means this rally had some breadth, not just a handful of trillion-dollar names carrying the index. Three forces drove the rebound. Oil pulled back early in the week on de-escalation signals. That sparked a risk-on rotation into oversold growth names. And better-than-expected labor data through Wednesday reinforced the view that the economy has not cracked under $100 plus oil. 10 of 11 sectors advanced. Only one fell: energy. Technology led at 4.67%. Communication services followed at 4.35%. Real estate gained 4.00%, and financials rose 3.60%. Energy lost 5.29%. Oil and gas E&P stocks dropped 5.56%. That energy decline is worth pausing on. XLE is still up 33.39% year to date, the best performing sector of 2026 by a wide margin. The weekly loss happened because traders who had bought energy as a geopolitical hedge sold when de-escalation signals hit Monday through Wednesday. The irony: actual crude spiked on Thursday, but E&P stocks didn't fully recover because the week's average sentiment in energy had already turned negative. Consumer staples barely moved, up 0.13%. In a full risk-on week, defensive names get left behind. That near flatness tells you the mood was optimistic. The March jobs report dropped on Good Friday. Markets were closed. Nobody could trade on it. The number: 178,000 new jobs. The estimate was 59,000. That is a triple. Unemployment fell to 4.3% from 4.4%. Healthcare added 76,000 jobs, roughly half from the resolution of a physician strike that had dragged February's numbers down. Before you celebrate, look deeper. February was revised down to negative 133,000 from negative 92,000. The 3-month average sits near 68,000 jobs. Over the past year, the economy has added only about 260,000 total jobs, roughly 22,000 a month. I was working with a client last week who asked whether a strong jobs number means the economy is fine. The honest answer? 1 month does not make a trend. The trailing data is soft. The March beat partially reflects a one-time statistical catch-up from the strike. The first market reaction to this number comes Monday morning. The Fed has held rates at 3.50 to 3.75% since December 2025. That is 4 months of no movement after 175 basis points of cuts since September 2024. At the March meeting, the vote was 11 to 1 to hold. The median projection shifted to just one 25 basis point cut for the rest of 2026. The Fed also raised its PCE inflation forecast to 2.7% from 2.4%. Those projections were set before oil hit $111.54 on Thursday. Morningstar now expects overall PCE to accelerate to 3.5% by April on energy prices alone. CME FedWatch shows an 89.2% probability that rates stay unchanged at the June meeting. Futures price roughly a 48% chance of zero cuts in all of 2026. There is open discussion among some economists of a potential rate hike if oil stays elevated into summer. A central bank forced to tighten into a slowing economy, that is the tail risk investors need to keep in view. A client told me recently she had been counting on 2 rate cuts this year to refinance her mortgage. That plan needs revision. The Iran conflict is now in its 6th week. This single week contained 4 distinct market-moving phases. Act 1, Monday through Wednesday, de-escalation signals circulated. Trump said Iranian defenses had been decimated. Oil pulled back. Markets rallied hard on relief. Act 2, Wednesday night, Trump addressed the nation. He committed to ongoing military operations with no ceasefire timeline. The speech was more hawkish than markets had priced. Act 3, Thursday, April 2nd. WTI crude spiked $11.42 to $111.54 in a single session, the largest single-day dollar gain for oil since 1983. Stocks absorbed the shock and still closed higher on the week, but Thursday's volatility showed how fast sentiment can reverse. Act 4, the weekend. Trump issued a 48-hour ultimatum: reopen the Strait of Hormuz or face consequences. Iran rejected it. That deadline expires Monday morning. A U.S. F-15 was shot down on Friday. The pilot spent 36 hours behind enemy lines. Special Operations Forces extracted him Saturday night. Every American rescued, no additional casualties. 20% of the world's daily oil supply moved through one narrow waterway, the Strait of Hormuz. Iran has deployed anti-ship cruise missiles to islands controlling the strait. That amounts to a virtual blockade of the planet's most critical energy choke point. The national average gasoline price has risen to $4.10 per gallon, from $3.19 just a month ago. In California, drivers are paying $5.91. Goldman Sachs estimates Brent crude could test $150 a barrel if disruptions persist into mid-May. At that level, every household in America feels it. At the pump, in utility bills, in grocery prices. On April 1st, NASA launched Artemis 2 from Kennedy Space Center. 4 astronauts, Commander Reed Wiseman, pilot Victor Glover, mission specialist Christina Koch, and Canadian astronaut Jeremy Hansen, are the first humans to travel to lunar distance since Apollo 17 in December 1972. By Saturday, the crew had passed the halfway point between Earth and the Moon. They fly around the far side on Sunday night. Not a market catalyst, but a reminder that human beings are still capable of building things that last longer than a news cycle. The value-aligned portfolio holds 35 stocks. 32 advanced this week. 3 declined more than 1%. The split between tech and energy was sharp. Our top 5 performers this week, starting with the biggest mover. MedPace Holdings gained 10.5%. This was a technical rebound from oversold levels. not a company-specific catalyst. Medpace runs clinical trials for biotech firms. The stock had dropped to well below its average analyst target before snapping back. Earnings on April 22 will be the real test. Alphabet rose 7.8%. The stock entered the week with an RSI of 18, deeply oversold. Wells Fargo raised its target to $397. Alphabet also launched Veo 3.1 Lite, a lower-cost AI video model. At $295, the stock sits well below the $368 average analyst target. AMD gained 7.7%. Our largest position by weight is at 5.07% of the portfolio. The Helios rack-scale AI platform is gaining traction with hyperscale customers. Earnings April 28. NVIDIA rose 7.4%. Pure risk-on recovery after 5 weeks of selling. Blackwell Ultra ramp continues. Earnings May 20th. Taiwan Semiconductor gained 7.1% and is up 11.6% year-to-date, the only one of these 5 in positive YTD territory. Earnings April 16th, the first major semi-data point of the season. Transparency matters. Here are the 5 positions that lost ground this week. Diamondback Energy fell 3.9%, still up 29% year-to-date. The decline mirrors the energy sector's de-escalation trade. An 11 million share secondary offering added selling pressure. Q4 earnings had already disappointed. If the Iran ultimatum escalates on Monday, FANG recovers. If it de-escalates, more downside. ServiceNow dropped 2.8%, down 33.4% year-to-date. Stifel slashed its price target from $180 to $135 on weaker federal government IT spending tied to DOGE budget cuts. The broader fear layered on top, AI agents reducing the number of software seats enterprises need to buy. April 22nd earnings will be existential for the thesis. Permian Resources lost 1.4%, but remains the portfolio's best YTD performer at plus 51%. Same de-escalation energy trade as Diamondback. Cisco fell 1.1%. General Motors lost 0.6%. Both mild declines with no company-specific catalysts. 2 paths from here. The bull case. Iran backs down from the Strait confrontation. Oil drops toward $90. CPI comes in firm but not catastrophic. TSM confirms AI capex on April 16th. The S&P's YTD loss narrows. Growth stocks continue to recover. The bear case. Iran escalates. Oil spikes past 120. CPI accelerates sharply. The Fed signals rate cuts are off the table. Services PMI cracks below 50. TSM reports softer AI demand. This week's rally becomes a classic bear market bounce. Real, but not the start of a new trend. Key variables. The Iran ultimatum on Monday, CPI midweek, and TSM earnings on April 16th. I worked with a client couple this past month who wanted to sell everything and sit in cash until the war ended. We walked through the math on what missing the 5 best days in a recovery costs over a 20-year horizon. They held. This week, their portfolio recovered more than it lost in the prior 2 weeks combined. 3 things matter most heading into Monday. Number 1, the Iran ultimatum. It expires Monday morning. The range of outcomes: military escalation, face-saving de-escalation, or extended standoff will move oil, risk appetite, and every rate-sensitive position in our portfolio. This is the only thing that matters at Monday's open. Number 2, ASML reports on April 15th, and TSM reports on April 16th. These are the first hard AI capital expenditure numbers of the earnings season. What TSMC says about order books and capacity directly sets expectations for AMD, NVIDIA, Broadcom, and NXP, all VAP holdings. Number 3, our portfolio is positioned across both energy and growth. Business values did not change in 72 hours. Oil spiking or dropping 10% does not alter the long-term earning power of the companies we own. The volatility is real. The businesses underneath are the same. Oh, and Artemis 2 flies the far side of the moon tomorrow. If you got value from this weekly breakdown, you are going to want this one right here, where I walk through how we pick stocks for the VAP portfolio.